Constantly losing the majority of your time with your family or your loved ones is very stressful. And on top of that, you're constantly overpaying taxes to the IRS year after year. You're constantly seeking relief but feel there is no way out. Well, don't worry. I am going to show you how to access some key tax savings by utilizing a powerful tax strategy called the short-term rental loophole. Leveraging this loophole will help you avoid W-2 and 1099 taxes every single year and nearly cut your tax bill to zero if done correctly. So make sure you stay tuned until the end. I am going to break down everything that you need to know about short-term rentals. Like, what is a short-term rental, the rules within a short-term rental, and how this short-term rental loophole can put tens of thousands of dollars back into your pocket every single year. So let's get into it. A short-term rental is a rental property with a lease terms of 12 months or less. There are two tests that will determine, according to the IRS, if you are considered to have a short-term rental. You only have to pass one of these tests. So test number one, if your average period of customer use is 7 days or less and you materially participate, or if your average period of customer use is 30 days or less and you provide significant personal services. So for example, if you rented out your rental property for 280 days out of the year and you have 50 bookings, your average period of customer use is 5.6 days. So you check off the 7 days or less test, which is the first test that we discussed. Now you just have to materially participate. It is important to remember that your average period of customer use must be 7 days or less. It must not be 7.1 days. This will disqualify you from test number one. So what is material participation? Material participation is when you as a taxpayer is directly involved in the day-to-day management or operations of your real property, trade, or business. When you satisfy one of the 7 material participation tests, it allows you to take your losses from your rental activities and offset your active income. Most taxpayers, when going through the material participation test, will focus on the top 3. Before we break them down, if you are finding value in this video, like, subscribe, and comment. So the first test. You as a taxpayer or your spouse must work 500 hours a year in the business. That's less than 12 hours a week. The second test, you must do most of the work. Test number 3 states that you must work more than 100 hours and no one can work more hours than you. Now there are 4 more tests. Just remember you only have to qualify for one of these tests in order to be considered materially participating. So if you have a short-term rental and your average period of customer use is 7 days or less, and you materially participated, we can now use your rental losses to offset your active income. In order to prove to the IRS that you materially participated in your rental activity, you must document your hours of participation by keeping a detailed record or logbook of the time you spend in your rental activity. Most of the time, not all of the time, rental properties will generate tax losses. So in order for you to move your rental property from the passive side to the active side, you would normally have to qualify for the real estate professional status according to the IRS and materially participate. But you now have access to the short-term rental loophole where you do not have to qualify for the real estate professional 2-part test to write off your rental losses. So what is the short-term rental loophole? The short-term rental loophole allows you to take losses from your short-term rental properties and significantly reduce the taxes on your W-2 or 1099 income. So for example, let's say you have a short-term rental property with an average cash flow of $30,000. Now your taxable income with your short-term rental properties is $120,000. You then decide to get a cost segregation study completed, which allows you to accelerate depreciation. They then decide that you have components inside like your stove, refrigerator, appliances, furniture, or fixtures that has a value of $150,000. So instead of spreading out the depreciation over 27.5 years or 39 years, which is a very slow process, we're now going to speed that process up. So so that you can use bonus depreciation to write off 80% of the value of the components within the first year. So if you decide to use bonus depreciation in year 1 and take 80% of the components value, which is $150,000, you now have $120,000 as a tax deduction, bringing your taxable income to zero. As you can see, the short-term rental loophole allows you to report a paper loss despite having a positive cash flow within your short-term rental properties. This is why the short-term rental loophole is one of the most powerful tax strategies if done correctly. If you would like to learn more about real estate, check out our videos above and let me know in the comments if you think this strategy will work for you. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.